You're scrolling through finance news, and it might as well be a foreign language. Bull markets, bear markets, PE ratios, none of it clicks. And here's the truth, that confusion isn't accidental. The stock market was built by people who already had money, and they didn't exactly prioritize making it easy for the rest of us to catch up. I'm breaking down every major stock market term you actually need to know. Not the textbook definitions, but what they mean for someone trying to build wealth while juggling rent, student loans, or just trying to stop living paycheck to paycheck. By the end of this, you'll understand the language well enough to make your own decisions, instead of nodding along while someone else controls your money. Right now, with inflation eating into every paycheck and the cost of everything from groceries to gas climbing, a lot of people are realizing their savings account isn't doing them any favors. The stock market keeps getting mentioned as this place where money grows, but if you don't speak the language, you're either sitting on the sidelines or trusting someone else to do it for you. Neither of those options builds real security. Let's start with the absolute basics. Stock. This is just a tiny piece of ownership in a company. When you buy one share of Apple stock, you own a sliver of Apple. If the company does well, your slice becomes more valuable. If it tanks, so does your piece. Shares. Same thing as stock. One share equals one unit of ownership. People use the words interchangeably. Shareholder. That's you if you own stock. You're literally a partial owner of that company, even if it's just one share. Now, where do you actually buy these things? Stock exchange. Think of it like a marketplace, but for stocks. The New York Stock Exchange and NASDAQ are the big ones in the US. Companies list their stock there, and buyers and sellers meet to trade. Ticker symbol. Every stock has a short code. Apple is AAPL. Tesla is TSLA. It's just shorthand, so you're not typing out full company names every time. Broker. This is the middleman. You can't just walk into the stock exchange and buy shares yourself. You need a brokerage account. Think Fidelity, Schwab, Robinhood. They execute the trade for you. All right, now let's talk about how stocks actually move. Bull market. This means stock prices are going up overall. It's called bull because bulls thrust their horns upward. When the market's been climbing for months, people say we're in a bull market. Bear market. The opposite. Prices are dropping, usually by 20% or more from recent highs. Bears swipe downward, so that's the visual. Bear markets make people nervous, but they're also when things go on sale. Volatility. This just means how much and how fast prices swing up and down. High volatility? Expect big moves. Low volatility? Things are steadier. Volatile stocks can make or lose you money quickly. Here's where people start to get lost. Valuation terms. Market cap, short for market capitalization. It's the total value of a company based on its stock price. You calculate it by multiplying the stock price by the total number of shares. A company worth $1 billion is a different beast than one worth 10 million. PE ratio, price to earnings ratio. This tells you how much investors are willing to pay for every dollar of profit a company makes. If a stock has a PE of 20, people are paying $20 for every $1 of earnings. High PE can mean growth expectations or overvaluation. Low PE might mean it's undervalued or struggling. Dividend. Some companies share their profits with shareholders. They pay you cash just for owning the stock, usually every quarter. It's passive income. Not every stock pays dividends, but the ones that do can be appealing if you need cash flow. Dividend yield. This is the annual dividend payment divided by the stock price, shown as a percentage. A 4% yield means you're getting 4% of your investment back in cash each year, assuming the dividend stays the same. But here's what most people miss. You don't just buy and hope. Diversification. Don't put all your money in one stock. Spread it across different companies, industries, even countries. If one sector crashes, you're not wiped out. Index fund. Instead of picking individual stocks, you buy a fund that tracks a whole market index, like the S&P 500. You're basically buying a piece of 500 companies at once. It's automatic diversification. ETF, Exchange Traded Fund. It's like an index fund, but it trades like a stock. You can buy and sell it throughout the day. Low fees, easy diversification. Mutual fund. Similar idea, but managed by professionals who pick the stocks. Usually higher fees. You buy in at the end of the day based on its net asset value. Now, the terms that show up when you're actually trading. Limit order. You set the exact price you're willing to pay. If the stock hits that price, your order goes through. If not, it doesn't. You control the price, but you might miss the trade. Market order. You buy or sell immediately at whatever the current price is. Faster, but you don't control the exact price. Bid. The highest price a buyer is willing to pay for a stock right now. Ask. The lowest price a seller is accepting to accept for a stock. Spread. The difference between the bid and the ask. Tighter spreads mean the stock is easier to trade without losing money to the gap. Let's talk risk and strategy. Blue chip stocks. These are shares in big, stable, well-known companies like Coca-Cola or Johnson & Johnson. They're not going to double overnight, but they're not likely to disappear either. Penny stocks. Stocks that trade for less than $5, usually from small or struggling companies. They're cheap, but they're risky. Lots of hype, lots of scams. Growth stocks. Companies expected to grow faster than the market average. Think tech startups. High potential, high risk. They usually don't pay dividends because they reinvest profits. Value stocks. These are stocks trading below what they're worth based on fundamentals. Investors buy them hoping the market will eventually recognize their true value. Portfolio. This is just all the investments you own combined. Your portfolio might include stocks, bonds, ETFs, whatever. Asset allocation. How you split your money between different types of investments. Maybe 70% stocks, 20% bonds, 10% cash. It's about balancing risk and reward based on your situation. Rebalancing. Over time, some investments grow faster than others, throwing off your allocation. Rebalancing means selling some winners and buying more of the losers to get back to your target mix. The real problem starts when people hear these terms and assume they need to be experts before they start. You don't. You just need to understand enough to avoid getting taken advantage of. Capital gains. These are the profit you make when you sell a stock for more than you paid. If you bought at $50 and sold at $70, that $20 is a capital gain. Short-term versus long-term capital gains. Hold a stock less than a year and your profit is taxed as regular income. Hold it more than a year and you get a lower tax rate. The system rewards patience. Capital gains reinvestment. Instead of taking dividend cash, you use it to automatically buy more shares. Over time, that compounds. Compound interest. This is the magic. Your gains start earning gains. Even small, consistent investments can snowball over decades. Risk tolerance. How much loss you can stomach without panicking and selling. If a 20% drop would keep you up at night, you probably need a more conservative portfolio. Time horizon. How long until you need the money? Investing for retirement in 30 years? You can ride out crashes. Need it in 2 years? Stocks might be too risky. Here's one more set of terms for people who want to go deeper. Short selling. Betting a stock will go down. You borrow shares, sell them, then buy them back cheaper later and return them. If you're wrong, losses can be unlimited. Options. Contracts that give you the right to buy or sell a stock at a specific price by a certain date. They're leveraged and risky, not beginner territory. Futures. Agreements to buy or sell an asset at a future date for a set price, mostly used by traders and institutions. Margin. Borrowing money from your broker to buy more stock than you could with cash alone. It amplifies gains and losses. Dangerous if you don't know what you're doing. The stock market isn't some exclusive club. It's a tool, and like any tool, it works better when you understand how to use it. You don't need to memorize every term or become a day trader. You just need to know enough to make informed choices and avoid getting sold something that doesn't fit your life. The language is designed to sound complicated, but strip away the jargon and it's just buying, selling, and owning pieces of companies. Once you see it that way, the barrier disappears. Real security comes from understanding the rules, even when they feel designed to keep you guessing. If this cleared things up, hit that like button. Subscribe if you want more finance breakdowns that actually make sense. And drop a comment if there's a term I missed that's been tripping you up. I'll see you in the next one.